the Monetary Policy Committee met on 6th, 7th and 8th June, and based on an assessment of the macroeconomic situation and outlook, inflation, however, is still above the target as per the latest data and is expected to remain so according to our projections. The GDP, the real GDP growth for 2023-24, that is for the current year, is projected at 6.5%, with Q1 at 8%, Q2 at 6.5%, Q3 at 6% and Q4 at 5.7%, with risks evenly balanced.
As expected, the Reserve Bank of India today maintained a status quo on the key repo rate, retaining it at 6.5%, and this comes as a slight breather for borrowers. But will rates fall anytime soon? Welcome to Easynomics. I'm Siddharth Zarabi, and I'm now joined by two noted economists, DK Joshi, Chief Economist at CRISIL, and Rajni Sinha, Chief Economist at CARE Ratings. Welcome to the show. Let me come to you, DK Joshi, to ask you that one question which I think is top of mind now. What really has the RBI done today apart from maintaining a status quo? Basically, have they dampened and pushed away any rate cut hopes?
Well, I think I would say so. The main objective, I think, of this policy was to take the pause forward, and I think that's what they did. I think one more addition, nuance that they added to this policy was that they made it very explicit that they are chasing inflation target of 4%, and they want to align the inflation to the target that I think they have been saying they want over the medium run. So that I think makes it very clear that they are not in a hurry to cut rates, and we do believe that the rate cut will not happen before the January-March quarter of 24. So there are a lot of ifs and buts in between. I think they also highlighted the omnipresent risks from the global scenario, because I think there is a risk of them slowing down faster. There is a risk of financial accidents, geopolitical issues. I think all those things they highlighted. And on top of that, I think despite a normal monsoon forecast from the Met, the risk of El Nino has not gone away. And even if the monsoons remain normal, I think their distribution over time, over geographies, cannot be predicted at this juncture. So that risk always remains. So they've highlighted that is a risk to, from an inflation perspective, I think, which they need to monitor very closely. I think apart from that, I think the messages were pretty straightforward on growth and inflation. Growth forecast, they did not change, because the growth momentum that we are seeing in the current quarter is quite strong, and I think they have a forecast of 8%, so it is on track. So they kept the growth forecast unchanged. Inflation, they cut down a bit, because the first quarter inflation forecast for this fiscal year, which RBI had at 5.1%, is likely to be close to 4.6%. So I think that these are some of the nuance changes that they made to their outlook. I think apart from that, I think we have to wait and watch as to how the scenario plays out. And as I said, I think first we will see a change in the stance, and which will be followed by a rate cut. And we believe rate cut will not happen before the January-March quarter of 24.
The delay in expectations of a rate cut playing out on the stock markets today, dampening sentiment a bit. But let's leave that for the moment. Rajni, what do you think gives the RBI confidence in the manner in which they have emphasized the 4% target and the point that DK Joshi made as far as inflation is concerned? The reason I am asking you this question is the southwest monsoon has arrived in Kerala, but a week late. We saw sort of different weather patterns, at least in North India, during the height of summer in the month of May. Given all of that, plus the global overhang, what really could have gone into RBI's emphasis on the 4% inflation target?
Calling 4% level their target, sustainable basis, and based on that, they will make their policy decision. While if you look at the average, that inflation number that they've given for FY24, they have very marginally reduced it to 5.1% from 5.2% that they had given earlier. So, and they have highlighted a lot of looming inflationary concerns. Like you highlighted, one concern is weather-related disruptions. We cannot completely, while IMD has given a projection of normal monsoon, we cannot completely ignore the risk of El Nino. So that's something which RBI would be conscious of. Second, like RBI has highlighted, they are concerned about any other global supply constraints which could again push up global commodity prices. So, given these uncertainties, RBI has preferred to, while they have maintained status quo on rates, if you look at the stance, there was some expectation in the market that probably they would move the stance to neutral. But they have maintained removal of accommodation as the stance because RBI wants to give the message to the market that they're still very cautious on inflation front, and they would
Okay.
like the market participants also to remain very cautious on market front, on inflation front. And in fact, not just RBI, globally, if you see, the central banks are indicating that they are going to be very flexible and they are going to be very data dependent. So they are not giving very clear forward guidance. And that's what even RBI has done.
One quick point, since you spoke about the stance, would it be fair to raise the point that does today's statement signal a tightening of the stance in some ways?
Not really. What they have done is that they have maintained the stance. Their stance was removal of accommodation, and they've just continued with that. What RBI is indicating, the signal that they want to give is that they will remain very cautious on inflation front. There are still inflationary concerns, though if you look at the momentum, it is coming down, supported by the base effect also, and because of food prices coming down. But there are concerns. If you look at some components of food inflation like cereal inflation, milk inflation, it's still very high. So given all these concerns, the indication that RBI wants to give is that we are still far away from the 4% target. If we are talking about 5.1% average, while it's within RBI's comfort band, it's still higher than the 4% target. And in fact, touching
Right.
that target on a sustainable basis, RBI has emphasized that what they are looking at is on a sustainable basis, inflation remaining at 4%.
Right.
So they have just continued with that, I would say. It's not really further tightening. They have just indicated that market should be prepared that they will act as per the data going forward.
Data dependency, that's absolutely always a feature of the RBI. DK Joshi, it's very clear that the headline inflation trajectory will continue to be impacted by food price dynamics. What's your own reading of how that particular dynamic could play out over the next 2 quarters?
Well, I think as I said earlier, I think a lot depends on how the monsoons play out, because I think there are several components of food. One is the cereals, which has a very high weight, and cereal inflation is in double digits. So I think for sustainably bringing down cereal inflation, good monsoons are very critical. We've had a good Rabi harvest that will help. But I think the Kharif is also critical because globally rice prices are going up, and rice faces the risks that played out in the case of wheat. So I think from that perspective, I think it's important that monsoons are well distributed and normal. So that is cereals is one. Second is milk. Now milk inflation I think is unlikely to come down, and our forecasts are that about 5 to 6% inflation in milk will be seen because some of the issues are structural in nature. And then I think you have edible oils where inflation is low, but the spices is another category where inflation is high. So it's a mixed bag that is playing out. And vegetables are also a large component of our food basket, and they react very quickly to inflation, to monsoons or to rains. And I think from right now, vegetable inflation is somewhat benign, but depending on how the rains play out, it could move up and down. But the major concern, I think, on the food front, I would say, is the cereal inflation, which is quite high, and the pulses inflation, which is gradually beginning to inch up. So I think these are concerns from the food side. I think the other components, which is fuel, I see fuel inflation come down quite substantially this year because the global crude prices are going to be lower than last year, and we could see some of the pass-through to the consumer also happen in this year. And I think as far as core is concerned, I think that's a different story. Maybe we can talk about it. It's goods and services play which is going on right now. Goods inflation is softening, whereas the service inflation, because of fast and furious demand for a variety of services, including travel, etc., inflation continues to remain high in that category. So there are many nuances to the inflation trajectory. Food is the most critical part of that.
The inflation basket in India, Mr. Joshi, as you have described, comprises of multiple beasts and mirrors in some ways the diversity of our country. That's a very good point. Rajni, I'm coming to you on your own sense of the inflation glide path. And while you answer that question, I also want you to tell our viewers if you have reflected upon what happened with regard to the MSP pricing decision that's just been announced in terms of how that is likely to impact procurement, and also there seems to be a sharp drop in output in wheat, for example, in Australia. How is all of that going to play out as far as the glide path is concerned?
If we look at glide path, our expectation is that inflation in the first quarter, as we have already seen from the last two data points, so we expect inflation in the first quarter around 4.5%. But towards the latter half of the year, we are expecting inflation to pick up. And in the first half, it's going down mainly because of base effect. And like we mentioned, some of the food prices have also gone down. But in the latter half of the year, inflation is again likely to pick up. And our expectation of inflation, average inflation for FY24, is pretty much in line with RBI's projection. We are expecting it to be around 5.1%. Now, coming to your second part on, this MSP and what's going to be the impact of that, as the RBI governor had highlighted, some of it was already taken into account in this projection, but the MSP hike has been higher than kind of, what was expected and what had happened last year. So if we take into account the additional hike, probably we don't see much impact of that. Probably a 10 basis point or so on CPI inflation, because the actual impact would also depend on, government procurement strategy and market prices going forward. So we don't see a very significant impact of that on inflation. But yes, we can expect around 10 basis point or so. Apart from, I think, food inflation, the other critical thing to keep in mind is what's happening on core inflation front. As DK Joshi highlighted, it's not just food inflation, we are also concerned about core inflation, of which a big component would be the service inflation that we are seeing. And if you look at service sector, a lot of strong demand that we had been seeing in the last few months. Earlier, the expectation was that it is pent-up demand and it is going to kind of wane off gradually. But so far, we are not seeing that in data. We are still seeing that the demand in the service sector is pretty strong. Given that probably the price pressure also is going to remain firm on in the service sector. So I think that's also something for which we need to be cautious.
Absolutely, and the services sector seems to be on some sort of, at least some parts of the services sector, some sort of a bull run really, pent up demand, and I think there's some structural change also that has happened as far as the services consumption trend in the country is concerned, and you could add parts of real estate, for example, but we'll leave that debate for some other time. DK Joshi, not to look back, but it is a significant question that can now be asked following RBI's statement today. In your own assessment, what impact have all the recent rate hikes had so far, if you were to explain that in a simple manner for our viewers?
Well, I think first point is that when the RBI raises interest rates, it transmits to other interest rates. I think housing rate loan go up, the auto loan rates go up, and this transmission takes some time. I mean, and then after that, I think this leads to slower growth and lower inflation. So this whole transmission to inflation can take about 3 to 4 quarters. So the rate hike started in almost exactly a year back, I think somewhere in April, May last year. And these rate hikes are beginning to percolate. I think they will interest sensitive segments like auto, like your housing, particularly the affordable housing. These start getting impacted. So the way RBI controls inflation by raising interest rates is that interest rates rise leads to slower growth. That leads to lower inflation. So the economy has to slow first for the rate hike to have an impact on inflation. So I think we haven't seen significant moderation in growth at all. I mean, actually, economy is quite robust right now. But as the RBI's projections also show, I think towards the second half of the current fiscal, we will see growth slowing down, and I think that will have an impact on your core inflation part. The food and the fuel don't get impacted by interest rates. It's only the core inflation, which is inflation excluding fuel, excluding food. I think that part is what the central bank interest rate hikes target. So I think the cost of funds have to, go up for the economy, for inflation to be controlled. And I think that's what we are in the midst of that. And the peak impact of RBI's actions will be felt in 23-24. They were not felt in 22-23.
Peak impact playing out in the current financial year. That's an important point, viewers, because that is going to influence a lot of things. Rajni, as I come to you, fuel price cut expectations are building up, and that's currently purely a fiscal administrative measure, because the daily price movement has been stopped for quite some time now, and as we head into election season and get closer to the big one next year, obviously there will be pressure that will build up. Given that, my final point to you on this matter, before I get both of you to talk about liquidity and the banking system as well, is, are you confident that domestic growth is on a firm footing, and barring the impact of the rate hikes, we are on sort of steady territory right now?
A pretty decent trajectory. I would not be much concerned on growth front, and so has been RBI's indication. RBI has maintained its GDP growth projection of 6.5%. And in fact, we have just revised our GDP growth projection to 6.5%. Our earlier projection was 6.1%. And this increase was mainly because of very healthy data, GDP fourth quarter data that we saw. So I would say growth is on a pretty firm footing. Not just the GDP data surprised us on the upside. If you look at the high frequency indicators also, like GST collection, auto sales, passenger car, two-wheeler, credit growth, PMI, manufacturing services, a lot of these indicators are showing robustness in the economy. I would say there are still few concerns that we need to be cautious of. One is on the external front. We have been talking about this concern for quite some time. Growth is slowing down, and India needs to be cautious because what's happening on the global front could impact us through various channels. And we have seen that in the past. So
Okay.
that's one thing that we need to be wary of. And second, I would say any weather related disruption. In case we have a severe El Nino and the monsoon is impacted, in that case, this whole rural demand recovery that we are anticipating and that we are seeing some signs of, that could get, disturbed. So I would say a weather-related disruption is the other thing which I would be concerned about at this point in time.
DK Joshi, I come to you on the other subject, and this concerns a lot of our viewers, which is what happens to deposit rates. And it's not directly, I mean, in some ways, the question is not directly linked to the repo rate status quo, but to do with the 2000 rupee currency withdrawal and the impact on banking liquidity. What's your own sense about deposit growth and whether savers can now expect lower or flat savings rate for their deposits?
Well, I think as far as the deposit rates are concerned, I think they would remain flat for at least for foreseeable future. I think unless the central bank signals otherwise. On the liquidity in general, see, the RBI governor did mention that about 50% of the 2000 rupee currency notes have come back into the circulation, into the system, and about 85% of them are as deposits. I think people have exchanged only about 15%. So clearly that means that the liquidity with the banking system will improve, and I think that also means that the central bank, because its policies stance is withdrawal of accommodation, they will not let the excess liquidity accumulate in the system, and they'll try to bring it down to near neutral levels. So I think all this, and I think governor also had pointed out that it will work both ways. I think if liquidity becomes less, then they will infuse. So they would basically, I think, try to keep the liquidity in line with the requirements of the economy. But at least in the near term, I think that should create some downward pressure on short-term interest rates. But let's see how it plays out. Right now, the yield curve is completely flat. Whether you have a 1-year government bond or a 10-year government bond, the rate of return that you are getting on them is exactly the same, which essentially actually is pointing that maybe going ahead you will see rate cuts. I think that's what the yield curve is telling you about. So I think from a consumer's perspective, I think I would say the deposit rates have probably peaked and they would not go beyond this. And going ahead, I think they're likely to stay at these levels for some more time before I think they start softening.
Rajni, would you agree with that, the point made by DK Joshi that deposit rates have peaked?
May go up a little more as the pass-through has not completely happened. But more or less, I would agree that it has peaked. And given that we are not looking at, we are looking at the RBI maintaining status quo, it's likely to remain around these levels, the deposit rate.
All right. I think that's the key message from both of you today. And, it might just be a complete coincidence that most economists, including both of you, are now talking about a rate cut in between January to March of next year, which will be a couple of months before the general elections, and with lower inflation, lower borrowing costs, and hopefully stable deposit rates, at least for that part of the economy which is concerned and sensitive to interest rates, there might be good news in the offing, not immediately, but in the new year. DK Joshi, Rajni Sinha, thank you very much for your time with us here on Easynomic. With that, it's a wrap on this episode. We'll be back with more. Do stay tuned in. See you very soon. Bye-bye.
Well, hello and a very warm welcome to Business Today TV. I am Chetan Murani. Today, I am joined by the Senior Executive Officer of Bharti Suzuki, Mr. Shashank Srivastava, on the monthly sales numbers. Thank you, Shashank, for joining us.